$100 to 700 in about 5 weeks. Then 70% of it gone in 3 days. That's Avis Budget, ticker car, April of 2026. Hey, what's up? Welcome back to Chalk Talks with Coach B. No options background needed for this one. It's pure stock mechanics. Drop your questions in the comments if anything doesn't click. Let's define the term first in one sentence. A short squeeze happens when traders who bet against a stock by borrowing shares and selling them get forced to buy those same shares back to close out the bet, and that forced buying pushes the price higher, which forces even more of them to buy, which pushes it higher still. So let's work through the actual example because the real numbers here are wild. Through mid-March 2026, Avis Budget is trading in the $80 to $100 range. Nothing unusual. By April 21st, it closes around $714. The next day, intraday, it prints near $848. Depending on exactly how you measure it, that is somewhere around 500 to 600% in about 5 weeks. Numbers like this vary a little depending on whether you're looking at a closing price or an intraday print, but the shape of the move is not in question. Here's how you actually get a move like that. NASDAQ had short interest on Avis running around 54% of the float, and near the peak that spiked toward 86% of the free float, meaning the shares that were actually available to trade. Now stack this on top. 2 investment funds, SRS Investment Management and Pentwater Capital, reportedly owned about 71% of the company outright, and through cash-settled swaps, their total economic interest ran over 100% of the shares. Between the two of them, they'd reportedly locked up around 82% of the float, which compressed the actual tradable float down to somewhere around 10 million shares. So flip the mechanic around for a second and put yourself in the shoes of a short seller. Say you'd shorted 100 shares at $80 back in March. That's $8,000 of exposure. If you're forced to cover near that $848 intraday high, you just spent about $84,770 to buy back stock you originally sold for $8,000. That's a loss of about $76,770 on a bet that the stock would go down. Multiply that across everyone who was short, fighting over a tradable float of about 10 million shares, and that forced buying is literally what was pushing the price higher. Traders call that ratio days to cover, how many days of normal volume it would take short sellers to buy back their entire position. When that number is high and the float is this thin, there simply are not enough shares to go around if everybody who's short needs to buy at once. And if there's an options market layered on top, it gets worse because market makers who sold calls into that run have to buy the actual stock to stay hedged as the price rises. So you've got short sellers covering and options dealers hedging, both buying into the same shrinking pool of shares at the same time. So what broke it reporting pointed to Avis warning it would release its first quarter results early, which raised fears the company might need to sell new stock to raise cash, and that alone was enough to flip the trade. The stock fell about 73% off that intraday high by April 23rd, and by April 24th, it had given back around 76% off that same high, closing around $204. 3 days. That's the whole round trip. Now, here's the part that actually matters for you. Say you bought 10 shares right near that $848 intraday peak. That's a little under $8,500. 3 trading days later, those same 10 shares closed around $2,040. That's about $6,400 gone in 3 days. And the whole time this was happening, Avis Budget was carrying roughly $25.3 billion of debt and negative shareholder equity. That did not change while the stock went up 500%, and it did not change when the stock gave most of it back. That's the single biggest lesson here. A short squeeze is a mechanical event. Forced buyers meeting a shrinking supply of shares. It is not a verdict on the business. The float, the short interest, the hedging, all of that can move a price violently in either direction, completely independent of whether the company is actually a good investment. If you ever see a stock with insane short interest ripping higher, that's your cue to go find out why it's shorted in the first place, not your cue to chase it. Quick reminder, this is education, not financial advice. I'm not telling you to buy or sell Avis Budget or anything else. Do your own research. That's the anatomy of a short squeeze. If this helped, hit that like and subscribe and drop a comment with what you want me to break down next. Good luck in the markets, no matter what stock you're into.